Hi, this is Antoine Harris with Platinum Bridge Wealth Strategies, and I wanted to check in for the second quarter. October 2018 was the worst October since 2008, and December was the worst December since the Great Depression. We were down in the fourth quarter almost 20%, which is a precipitous drop, but we've made a pretty nice recovery so far. The Federal Reserve had indicated that they were going to increase rates 4 times in 2019. They've since kind of put themselves on the sidelines. So we're expecting 0 to 1 rate increases here for 2019. And the fact that the Fed's kind of backed off a bit, that's been the catalyst for this market rebound that we've seen. So where do we go from here? Well, the economy is expected to grow at about 2%, a pretty tepid pace, but we're still expecting some growth. The first quarter, actually, we exceeded that 2% benchmark. We grew at 2.8%. So we're still expecting some growth from here. I'm expecting modest returns for the stock market going forward. I have you focus more on dividend paying stocks. Those dividends occur even if the market's down. So that acts as kind of a buffer and a ballast against market volatility. Now the yield curve has been very flat. We're getting paid the same amount for 6-month bonds as we are for 5-year bonds. So you're going to see in the portfolios me skewing you more toward very short maturity, short duration bonds for that reason. If you like more information, I continue this video with some more detailed charts just for your information. Otherwise, if you have any questions, this is Antoine Harris with Platinum Bridge Wealth Strategies, and I'll talk to you soon.
Okay, here we go. So the fourth quarter of 2018 was a debacle. This was one of the worst quarters that we've seen in the last decade, and December was the worst December since the Great Depression. So we were down. This is the peak here in October. We were down almost 20%. 20% indicates a bear market. We barely missed it. This is the recovery through the end of March. So we've rebounded quite a bit. As of the end of April, beginning of middle part of April, we're back to where we were in October. So the implication here is, one, the valuation is right around fair value. So this dotted line is the historical price to earnings ratio of the U.S. market. We're trading right there. So the historical price to earnings ratio is around 16.2. We're at 16.4. So the market's not expensive. The market's not at a discount. It's right around fair value. And when we peel the onion back a little bit, this shows the S&P 500 at about a 16, but this shows the growth portion of the U.S. market at around a 20, almost 21, and the value portion at around 14. So what that means is the faster growing companies are much more expensive relative to the more conservative dividend paying value-based investments. So the growth are trading at around a 21 multiple, whereas the value-based companies are trading at around a 14. So I'm skewing the portfolios more toward the value-based dividend-paying companies because they're trading less expensively. As the market starts to become more volatile going forward, these companies are going to be a bit more stable. The income's coming in, and relative to these growth companies, they're trading at a discount. Now, when I look at the emerging markets, it's the same thing. The emerging markets are trading at a 12.4 multiple, and they're trading at a 15-year low relative to the U.S. market. They're trading at a 15-year discount. So they're definitely on sale. So I've been increasing emerging markets for the last couple of months in the portfolios. You may have seen that. Now, looking at the bond market, this is the yield curve. So this shows the bond payments for different maturities. So this is 1 month, 3 months, 6 months, all the way out to 30 years. Now, typically, you have a situation where the bond market has an upward slope to it. That means you're going to get paid less for a bond maturing in 1 month than you would if you tie your money up for 30 years, which makes a lot of sense. This is a normal sloping, positively sloping yield curve. This is last year. This was April 2018. The yield curve has flattened quite a bit. This is the current yield curve in red. So right now, you're in a situation where you're being paid more for a 6-month bond versus a 5-year bond. Well, that's atypical. That's an aberration. So what you're seeing in the portfolios, what I've been doing is I've been skewing the maturities for the bonds in the portfolio to the short part of the yield curve, having very short maturities because we're being paid more on the short side than we are for bonds that are maturing much further out. At some point, the yield curve is going to normalize again and start to look more like this, where we're going to use some different strategies in that environment. The Federal Reserve was a critical reason why the market started to go down during the fourth quarter. The Fed had indicated that they were going to continue their aggressive rate hike policy. They kind of backed off of that a bit, which was the impetus for the market to recover. Now, right now, they're on the sidelines. We're going to continue to monitor that situation. We could see the catalyst for inflation going forward, which would bring the Fed back into the fold, and they potentially could start to increase rates again, which would be a headwind for the market. So I'll continue to monitor that. If you have any questions, let me know. This is Antoine Harris with Platinum Bridge Wealth Strategies, and I'll talk to you soon.